Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is March 19th, 2025, and we're diving into Signet Jewelers' latest earnings report for the fourth quarter and full fiscal year 2025. Joining us is John, senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. It's a pleasure to discuss Signet Jewelers, the world's largest retailer of diamond jewelry, and their recent financial performance.
Revenue and profitability overview. Let's start with the top line. Signet Jewelers reported sales of $2.4 billion for the fourth quarter, which is a 5.8% decrease compared to the same period last year. John, how does this impact their profitability?
Despite the decline in sales, Signet managed to deliver an adjusted EPS of $6.62, beating the forecast of $6.39 from two analysts. Their operating income was $152.6 million, down from $416.3 million last year, largely due to non-cash impairment charges related to their digital brands.
That's interesting. So even with a drop in sales, they managed to exceed EPS expectations. What does this say about their operational efficiency?
It indicates that Signet is effectively managing costs and optimizing their operations, even in a challenging sales environment. Their focus on operational efficiencies and strategic initiatives is clearly paying off.
Strategic initiatives and future outlook. Signet's CEO J.K. Symancyk mentioned a new strategy called Grow Brand Love. Can you elaborate on this and how it fits into their future outlook?
Absolutely. The Grow Brand Love strategy aims to enhance their product assortment with more style and design-led offerings, particularly in self-purchase and gifting categories. This is part of their broader plan to drive organic growth and expand their leadership in the bridal segment.
And how does this align with their financial guidance for fiscal 2026?
Signet is projecting sales between $6.53 billion and $6.80 billion for fiscal 2026, with a focus on a measured consumer environment. They're also increasing their dividend by 10%, which reflects confidence in their cash flow and commitment to returning value to shareholders.
Operational efficiencies and market challenges. John, let's talk about operational efficiencies. Signet's gross margin was $1.0 billion, down from last year. What were the main factors affecting this?
The gross margin decline was primarily due to fixed cost deleverage, despite a 30 basis point expansion in gross merchandise margin. Additionally, SG&A expenses were $639.2 million, reflecting higher advertising costs on lower sales.
And how did impairment charges impact their financials?
Signet faced $200.7 million in non-cash impairment charges, mainly related to their digital brands. This significantly impacted their operating income, highlighting the challenges in digital brand recovery.
Key takeaways. In summary, Signet Jewelers has shown resilience in a challenging market, with an adjusted EPS of $6.62 beating expectations. Their new strategy, Grow Brand Love, and a 10% dividend increase signal a positive outlook. John, any final thoughts?
Signet's focus on strategic growth and operational efficiency is commendable. While they face market challenges, their proactive approach and strong cash flow position them well for future success.
Thank you, John, for your insights. And thank you to our viewers for tuning in. Don't forget to like, share, and subscribe to Smart Stock Watch. We'd love to hear your thoughts on Signet's performance in the comments below.